Good afternoon, Jax. This is Fahad. Today is Friday, May 8th. You know, it has been a while since we did a Jaguar media production. We would like to get back in the rhythm. This time, we are bringing Chronicle U, one of our own Chronicle U here into this presentation, who would like to discuss the stock BHP with a bearish view. Hi, Chronicle. How are you doing?
Hi, Fahad. I'm good, thanks. How are you?
Excellent. You know, when I saw the bear case that on the BHP that you had presented in front of me, it reminded me a lot of Freeport McMoran from way back in 2014 when I presented that as a top short idea to my clients. And at the time, the stock was trading at 35. And despite Carl Icahn having a large stake in the company, we drove that stock down all the way from 35 to $10 per share. And now here we have a similar kind of bear case for this metal and mining company, BHP Group, currently around 41. And you think that over the course of next 2 years, this could trade all the way down to single digits.
Yep, low teen single digits.
Wow, that's one heck of a bear case. So without spending any more times on this, let's get started with the presentation. Tell me about it. What do you think?
Okay, so I'll start by saying if we take a high level view of what's going on, I think US dollar and US is still a place for money to be. Like if we look at FX flows and if we look at the money Fed is printing and allocating, it'll probably stay in the US. And I don't see money going out to Europe or emerging markets. And so we are more likely to see increased repatriations by American companies and investors rather than money going out. And what this means is if I want to short some companies, I'd rather short some foreign companies that do most of their business globally.
I see. And BHP fits that bill because naturally it's also very much tied into slowing manufacturing environment in China.
Yep. And so, as you said, I'm looking at several different themes of secular decline, and one of them is China. In specifically, I'm making a call that China is never going to fully reclaim its former manufacturing growth, nor do they intend to do so.
Excellent. But there's more parts of this China that is largely related to just the overall consumption trends and how they're changing and simply running out of dry powder to continue to push the manufacturing side into build out of the country the way that we have seen in the past. You don't believe that the last 10 years is going to be duplicated in the same way going forward from here?
Yeah, I think we're going to see a different kind of allocation going forward. And this leads to my first reason why, because um, in short, China does not have the capacity to repeat its massive infrastructure stimulus programs of the past. When China did its $600 billion stimulus in 2008, debt was only 27% of GDP. Then fast forward to 2015, 2016, China unleashed a record $1 trillion in total social financing, and it only resulted in growth accelerating by two basis points in 2017. So that's a massive deceleration. If we look at the first graph on the left, we can see that majority of growth we've seen from China over the last 12 years was due to accumulation of debt more than anything else. And if we look at the chart on the right, it shows that back in 2007, China only needed 3.5 units of capital investment to generate 1 unit of growth. Then all of a sudden in 2016, it needed 8.7 units of capital investment for 1 unit of growth.
It's a classic example of how the velocity of money goes down with each dollar that is printed in order to boost the social welfare state, essentially. Moving on, the second biggest headwind that you see is related to the real estate market in China.
Yep. So first off, Chinese citizens have a vast amount of their wealth tied up in real estate. You can read more about it in my research piece. But essentially, this is a two-part problem. First, in the tier 1 cities, so Beijing, Shanghai, Guangzhou, and Shenzhen, what we'll find is that these cities boast some of the highest price to income ratios, not just in the nation, but globally as well. So there is an affordability problem. and the government is aware of this, and they can't exactly solve it with more supply because there's no more land left in these urban areas. And they attempted to cool down the market by introducing measures in 2016, but as you can see on the graph on the right, those measures only work temporarily. So that's the first part of the problem. And if we go to the next slide, is when we take a look at the tier 2 and 3 markets where um, a lot of these a lot of these low cost and lesser quality apartments began springing up, and they ended up unfinished due to eventual lack of funding and demand. Latest estimates show that the total number of these empty apartments are above 100 million, and only 46% of them have been sold as of December 2019.
Wow. I mean, this is why we often hear the term ghost towns in China. 100 million empty apartments. Do they even have people to occupy all of that?
No, and a lot of these potential buyers were actually put off by the quality, and that led to a price war between the developers, which still goes on today.
Yeah.
And this financial strain of being unable to offload what I call garbage inventory has also resulted in price slashing within legitimate communities as well. And so this culminated in a series of protests in late 2018, which I'm sure the government doesn't want to repeat.
Yeah.
And so this two-part problem is really China cannot build more in tier one cities, and they also cannot build more outside of tier one cities.
Yeah, and that all of that compounds to the biggest iron ore producer that is providing all the material for all of this development. So that takes us to BHP case.
Right.
On quickly on the third headwind that you have identified also has to do with age dependency. What are your thoughts on
Mhm.
this?
So first things first, we are seeing some increased hostility from the West towards China. And given recent headlines from EU and the White House, that's probably an understatement. So first, the first part of this headwind is an over-reliance on China. And when the coronavirus reached Europe and the US, the Western world suddenly realized they don't manufacture enough of their own things. And right now, there's already a lot of noise about wanting to relocate. And how will this affect iron ore demand? For one, less exports mean a deteriorating current account for China, which further decreases ability to fund infrastructure. And another thing is this will only serve to speed up China's transition to being more services oriented. The leaders might be thinking if domestic manufacturing is going into slow burn contraction, then why not just help it along? On top of that, decades of one child policy and emphasis on career building has left the nation with a rapidly aging population. And so if you look at the graph there, UN is estimating China will overtake US in terms of old age dependency by late 2030s. And so what this means is manufacturing output is it's pretty much going to decrease in the long run. It's inevitable.
Yeah, that's a serious problem actually facing a lot of Asian countries, and it's possibly going to become more pronounced in places like China as well.
Mhm.
Now, this is now talking about BHP in particular. The key here is really the iron ore prices, isn't it? And here, this
Yep.
one slide is showing the relationship between Aussie dollar and the iron ore prices.
Yep. The cleaner way to short Chinese manufacturing is to short Australia due to its heavy reliance on iron ore exports. And to keep it simple, I've identified BHP and Rio, but I've chosen to go with BHP as a short idea due to its assets being more at risk than Rio's and also the inferior balance sheet compared to Rio.
Now, staying on this with the iron ore chart that you see on the right-hand side over here versus the US dollar, I do want to point out about 63% of fiscal year 2020 EBITDA projections from the company are all based on iron ore. It's a very large segment of the total company. Now, iron ore prices are down about 6.1% year to date. they have recovered a little bit from the February low. But right now they're trading at about $86 per ton. But I think we often forget that when the commodity cycle turns, how ugly it gets for the group. All you have to do is just look back in in 2015, and we saw the iron ore prices went as low as $40 per ton, so about more than 50% than where they are trading right now. Do you think that that's actually a realistic possibility that could happen to iron ore futures going forward from here?
Yeah, so first of all, a lot of the rocket that was lit under the iron ore prices was due to the Vale Dam disaster. And going forward, I don't think a lot of steel price producers can take iron ore prices which are too high due to COVID-19. So I think there's a lid on prices right now, and yeah, I do think it can go lower.
Another thing to add to that, naturally, iron ore is a critical part of steel making, and it should be pointed out that steel inventories in China are currently at record high as of the latest reading as of early April, and they were up 88% year to date. So excessive inventory of steel already out there at a time when the actual economic environment is deteriorating. So naturally, iron ore prices that takes that just pushes it down further going forward from here.
Yep.
Now you mentioned over here in this one that the key thing to note is the 55% of revenues come from China. And I'm trying to just make a bigger picture in my mind. So more than half the revenues come from China. A lot of that goes into steel making. Steel inventories are up 88%, right? And so here we find ourselves at a time of slowing economy. What are your thoughts on all of this at this time?
So if we put together all of the company's revenues, if we go to the next slide, so this graph on the left shows the company's past 5 years of quarterly production, and we can see that petroleum and coal have been in decline, while copper and iron ore haven't really enjoyed significant growth. And so that the entire bull case is really standing on copper and iron ore. But as you said, the vast majority of EBITDA comes from iron ore.
Yeah.
And
Um, quickly on the petroleum side of things, it should also be pointed out that's about 12% of the EBITDA projection for the fiscal year 2020. And I'm just reading, the general international large integrated oil producers. Everyone has their break-even points around $55 per barrel. Same thing with BHP. We know crude oil is trading the spot right now at 23, and even the curves looking out 12 months is at 35, $37 per barrel. Uh, this business isn't coming back for this company anytime soon, is it? I mean, 12% of projected revenues and projected EBITDA depends on crude oil itself.
yeah, you took the words right out of my mouth there. And I would add that the overwhelming majority of BHP's assets are offshore, which comes with its own problems.
Yeah, so you add petroleum and to iron ore, and now we're talking 75% of the company's EBITDA projections are in potential downfall here.
Mhm.
They're not sustainable, and there needs to be significant cuts to that. Now, staying on that topic, I have a chart over here of one of my own that I would like to bring up, and it's this one. When you look at this EBITDA breakdown, this is the street projections right now for fiscal year 2020 and 2021 for BHP. Look at that for 2020 total EBITDA for petroleum. The street is expecting only 4.7% decline. That just seems so out of whack. I mean, considering where oil is right now. And then similarly on the iron ore EBITDA, the street is essentially flat on the projections at a time when the steel production is going to go down sharply in China with the economic deterioration. Do you even believe these numbers?
No, I don't. But what I'm implying here is that even if these numbers are right, the stock will still drop from these levels because it has run up while estimates have actually been cut. So I think they can get cut further, but even as they are even as these numbers are right now, the stock should still go down from here.
Interesting. All right. And then just to wrap this up, what are your biggest takeaway right now when you look at this stock?
So one of my favorite short setups are when the stock bounces higher in the near term, while consensus estimates for the next couple of years are continually being revised lower, which is the case for BHP. So to me, this looks like an easy short.
Right. And now looking at the chart, the case that you're making is that the stock is around 41, 42 right now. You believe that this may bounce all the way up to 46 and at some point with the market bounces that we are seeing. But then after that, a prolonged downturn could be had well into 2021, taking the stock all the way down to teens.
Yep. It's not going to go down in a straight line like that arrow, but I do expect it to get there eventually.
I see. Great. So this is potential short, in my opinion, at a time when this market starts to lose its fizzle, and then who knows? That may actually happen beginning from second half of 2020, and then from that on, we're looking at a pretty significant downturn to come over the course of the next year and a half. Um, all right, gentlemen, and all right, folks, I should say, Jaguars, thank you very much for joining over here. This has been a fantastic presentation, and I'm happy to have Chronicle on my side to present this case. If you like this presentation, please send me a comment and let me know what you think about this. We're going to actually now do more productions on Jaguar Media along this kind of thought process where you will get a slide by slide discussion with me and my research team about which stocks we are looking at and what the rationale is. You will also get full, complete written write ups that will come along with it. And in the Jaguar Media website, the URL links for those write ups as well as these presentations will be provided. So if you would have ever wanted to read that on your own. We're going to end over here. Chronicle, it was excellent it was very nice to have you here. Thank you very much. And hope you all have a great weekend.